Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 27th February 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Seiko Kataoka Fisher, Director from Japanese Customer Sales for EMEA in London. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Lee.
Hi, Seiko.
The Japanese yen has underperformed this week, lifting the back up 156 level. What have been the main drivers?
Yeah, like you said, we've seen dollar yen moving higher again this week. The main drivers, in our view, are the media reports in Japan that Prime Minister Takaichi has voiced some apprehension over any further BOJ hikes when she met with BOJ Governor Ueda last week. Previously, it had been reported that no major issues had come up between the pair. But like I say, those media reports are suggesting that perhaps Takaichi there is trying to lean more on BOJ to slow down the pace of rate hikes going forward. So that has certainly re-energized the market to put back on short yen positions in anticipation of further weakness going forward. And then on top of that as well, we also had an announcement from Prime Minister Takaichi that she's nominated two academics to join the BOJ board from April and July of this year. And those two academics are known for supporting reflationist policies. So while we don't think their immediate appointment on the board would trigger an initial kind of change in BOJ policy, it does highlight that going forward that Prime Minister Takaichi looks like she's trying to kind of create a BOJ which is more supportive for maintaining kind of looser monetary policy to support kind of stronger growth and inflation going forward. So that certainly is playing into the yen weakness that we've seen this week. But like I said, it hasn't triggered a significant kind of shakeup in terms of market pricing for BOJ rate hikes for this year. Market's still pricing in around 17 basis points of hikes by April and by about 50 basis points of hikes by the end of this year. So in terms of the immediate market expectations, I think the next kind of key event to watch will be next week's speech from Deputy Governor Hamino at the start of next week. We'll be looking there to see if there's any potential shifts in BOJ rhetoric. At the moment, we're still very much kind of in line with market expectations in anticipating that the BOJ remains on course to hike rates again as soon as April. Obviously, if that didn't materialize as we're expecting, then that could trigger some further yen weakness in the coming months. On top of that as well, I think the other factor which is also having a negative impact on the yen this week is the geopolitical developments in the Middle East. We've seen obviously the price of oil moving further above $70 per barrel this week as market participants are nervous over the risk of some form of US military action in Iran if they fail to reach a diplomatic solution in the coming week. Like we've been saying before, I think if we did see a bigger or more sustained adjustment higher in the price of oil, I think that would hit European and Asian economies like Japan harder than the US economy. And that, I think, would put upward pressure on the dollar. It would certainly increase the risk of the dollar being stronger than our forecasts are anticipating going forward.
We've also seen a weaker pound this week. The sell-off has picked up after the by-election in Manchester. How do you expect political risk to impact the pound?
Yeah, like you said, we have seen the pound underperforming in recent days. Just today, we saw the pound fall to its weakest level against the euro so far this year after the disappointing by-election results for the Labour Party. In that by-election, we saw Labour dropping to third place, coming in behind the Greens and the Reform Party. So it was a big drop in terms of the popularity of the government. Obviously, in the general election back in 2024, the Labour Party won a comfortable majority in the same seat. So to fall to third place is a pretty dramatic drop in their support. So yeah, that does put more pressure, I think, on Prime Minister Keir Starmer. He previously had made the decision alongside the Labour leadership to prevent Manchester Mayor Andy Burnham from running in this by-election. That decision now has backfired and will raise further kind of question marks over his decision making as Prime Minister. You could also say as well that strong performance of the Green Party could also encourage some Labour MPs to push for a more left-leaning candidate to replace Starmer if there was to be a leadership election and going forward. And from a market perspective, the fear of a more left-leaning Prime Minister, I think that would certainly add to fiscal risks in the UK and could lead to a sell-off in the pound going forward as well. I would say, though, that we're not expecting an immediate leadership challenge to emerge at this point. I'd be surprised if that happened after just one by-election. But if we were to see a similar kind of disappointing performance for the Labour Party at the upcoming local elections in May, then that would certainly intensify the pressure on Prime Minister Starmer, and we could then see that leadership challenge emerging. So yeah, I think that still to us is the key kind of point in time where we could see the pound come under more downward pressure would be around those local elections in May. For the week ahead, though, I think fiscal risks will still be in focus. We do get the release of the spring statement, but we don't think this time that's going to be a big market mover. We're expecting that to show that the government's fiscal headroom is likely to be largely unchanged from back in the autumn when they estimated that the headroom at just over 20 billion sterling. We'll also see some good news as well on the fiscal front, we think, for the government, with the Debt Management Office expected to announce smaller amounts of gilt sales for the upcoming fiscal year of just under $250 billion. That's down by about 60 billion from the current fiscal year. So it's not all bad news for the government. Like I say, there does appear to be some good news on the fiscal front, but those political risks are likely to persist as a downside risk for the pound going forward.
Thank you very much, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.